Howdy, Jacob here. Today we're looking at Euronet Worldwide in the IT services industry, 4.4 billion market cap, 3.4 billion enterprise value. So not a lot of net debt here. In fact, way more cash on hand than debt. So actually the net debt is negative. Provides payment and transaction processing and distribution solutions to financial institutions. Founded in 1994. Their revenue growth is very impressive. The only year going down is COVID. Outside of that, you're looking at 6 to 15% a year. So very impressive. Gross margin and operating margin both up a couple percentage points. So earnings per share growing very heavily. Return on invested capital is okay, probably that 8 to 12% range. So possibly above weighted average cost of capital, meaning that they are increasing business likely. And if they're reinvesting, they're reinvesting at a very solid rate of return. Double-digit reinvestment is pretty impressive. No R&D spend, a good amount of cost of goods sold expenses. 1.8 billion cash on hand, 150 million short-term debt, 1.7 billion long-term debt. So essentially the same amount of cash as short-term and long-term debt. Not concerned with that balance sheet at all. Their cash flow statement has CapEx going up about 50%, with cash from operations going up almost triple. So much more production of free cash flow, with the use of cash being share repurchases and acquisitions. They have gone into debt. They've issued a lot of debt consistently since 2018. And again, that's not a big concern, because if you issue $100 million in debt, but you increase your cash from operations 50 million or so, then that ratio really isn't that bad. And so it's not a terrible concern, especially with the amount of cash they have on hand. But I do prefer companies using 100% of capital allocation and only going to debt if they absolutely need to. Like if they are incredibly confident repurchasing of shares would give them a 15-20% rate of return, that could be big. And then also acquisitions, if they have a 2 billion acquisition, they only have a billion in cash, financing a billion of it. If it's an opportunity of a lifetime, is really not a big deal, or even just an opportunity of a decade or so. And so for me right now, I will be assuming 100% capital allocation, and I'm ready to make some assumptions. I'm going to say on the revenue growth side, probably comfortable with maybe 8% seems good to me, with margins of, what do we have here, 6, 12. I love that free cash is a bit higher. Maybe let's do 9 and 11. Share change, buyback a lot of shares is 44 million is 1%. So 40 times 3, 120, 200. Okay, 3% seems very reasonable for share repurchases. And I mean, pretty big multiple here. Yeah, it's looking like a decent price right now. So this will be something I'd hopefully do more research on soon. Hope you enjoy the video and have a great rest of your day.